Hey guys, welcome back again. Anthony Allen, your mortgage broker, continuing the first home buyers series. So we've considered quite a few sections now, and hopefully you've gained knowledge along the way. I want to talk to you now about repayment terms. How are you going to pay this loan back once you've been approved, once you've moved in, once you've started repaying it? What terms have you set to do this on? So the first thing that I want to just explain, and this is easy really. Are you paying principal interest or interest only? Now, given that this series is for first home buyers, I very much doubt that you're going to have interest only terms. But I'll just briefly touch on this for completeness. Interest only is if you have a term of 1, 2, 3, 4, 5 years interest only. What that basically means is your repayments literally just cover the interest only portion. So if you've got a $400,000 loan, and whatever your repayments are, at the end of each month, your principal will not reduce, and at the end of that term of interest only, then you will still owe the same amount of principal, and you will still owe the same amount of principal. So you'll still owe $400,000. Okay, so that's pretty straightforward. For P&I loans, basically you're going to be chipping away every single month at your principal amount, at your loan amount. So initially, like with all loans, you're going to be paying, it's going to be paying a hell of a lot amount of interest initially. But eventually, it'll go like this on a curve. Eventually, you'll start chipping away more and more at the actual principal portion. Now, what I'd like to discuss a little bit more is whether you should be looking at fixed loans or whether you should be looking at variable loans. So if you want to, let's take fixed first of all. If you want certainty of payment for a specific period of time, fixed loans generally range from 1 to 5 years. 1, 2, and 3 years are generally competitive, especially at the moment. Generally 4 and 5 years, the interest rate goes up quite a little bit. Fixed rate loans are generally available for the same rate with most of the lenders at this moment in time. They're not LVR specific. So you could be at 80% or 85 or 90 or even at 95%, and you'd still get a really competitive rate. Whereas if you were choosing variable, to be honest, if you're 80%, you get a better discount than you would at 95, but I'll talk about that in a second. But the disadvantages with fixed loans are basically you generally don't get an offset facility. And that might not be a concern. Look, if you haven't got a lot of money to put into your loan or pay additional monies off your loan, then that's not going to be a concern. And probably if you're a first home buyer, you're probably not going to have money to burn and a lot of money to pay additional into your home loan. And the first few years are always going to be the hardest. So if you don't want to be watching the news at night and hear that interest rates are going to be going up and that's going to scare the bejesus out of you, then that's probably worth its weight in gold. Having said that, at this moment in time, I can't believe that interest rates are going to go up anytime soon. Certain economic conditions following the bushfires and the most recent COVID pandemic probably mean that interest rates won't go up in the next few years. But you never know what's going to happen. So it really depends. So the other disadvantage generally with fixed loans, apart from the main one, of course, the other disadvantage is with most providers, if you pay extra money into your home loan, into your fixed loan, then any additional monies are sort of locked away until the end of that term. So if you've put another 30 grand into it, then you generally can't access that in an emergency until if you're on a 2-year rate until the 2-year rate has finished. That's not the case, obviously, with variable loans. However, there are some providers that will allow you to pay additional monies in. There's some providers that will provide an offset on a fixed rate loan, and there are always exceptions to the rule. And again, all the providers will offer different rates, different products, and different criteria and different options within those products as well. So it's it's worth exploring, but ask your broker exactly what options you've got available and what they think are best for you. Now, the absolute obvious, or I think it's obvious, disadvantage, but it's also could be an advantage, is that you're in a fixed rate loan. So it's fixed for a certain period. So if you decide and you've gone in for a fixed rate loan of 2 or 3 years, and you decide that you want to come out of it earlier, then there will be a penalty to pay. So just bear that in mind. Okay. Moving on to variable loans. Okay. Now there will be an option general with most banks that it's a simple, basic, no frills option. It generally comes with very little fees, and generally the interest rate is quite competitive. The only thing is that it won't come with a free credit card. It won't come with an offset account or anything like that. And if you do need those, or you've got a larger loan where a discount can be negotiated with the lender, then you possibly better go in for a package loan. Although package loans will come with an annual fee, and generally it's around about $400. There are some lenders out there that charge a $300 fee, or there's some lenders out there that will charge a monthly fee. Again, all lenders are different. So as you are sort of getting to become more and more aware of, then there are no two lenders alike. All the products are different. And basically, it's going to depend on your personal unique situation as to what is actually recommended for you. And the product and the rate and whatever you decide has got to be tailored with your short and long-term goals in mind. Because, look, there's no point fixing a rate if you plan on doing something else. Or, it's at the end of the day, it's unique to you. So good luck. And hope to speak to you soon. Thanks. Bye.